So I wanted to make this video because it's a topic that affects a lot of people. So a lot of people are retirement age just because it's a large segment of the population right now are near retirement age. Some people are worrying about if they can qualify in the future when they leave their job and retire. Also, a lot of people have a kind of a limited income right now as opposed to a few years ago, just because of COVID, the economy at large, right? So there's a lot of people kind of on the margin where if they do a couple things, they can qualify for a mortgage. So let's just say for a cash out refinance. If they do a couple things, they can kind of put themselves over. And there's very limited information on this. I looked it up myself. I only saw, I think, 2 videos on YouTube, and they were older. So I just wanted to make a video, no text, no graphics, but just give you the information. So step 1 would be simply paying off other debt within the mortgage. Keep in mind, you want to it's all about your debt to income ratio, right? So your gross monthly income divided by your debts. So that's going to be the mortgage itself, tax, insurance, HOA fees if there are, your minimum payment on your credit cards, and then any installment loans you have, and even your student loans. So even student loans and deferment, they're going to take a small percentage of the outstanding balance, and they're going to count that as a monthly expense, right? So simply paying off debt is my tip number 1. So homeowners have extremely high equity if you look at the country at large. We recently passed $11 trillion in home equity. So what you can do if you're kind of limited on the income but have a lot of home equity, you can pay off these other debts, perhaps your car loan, number of credit cards. If you do that, you can kind of stretch a term with a mortgage, get a better rate, and it'll lower your monthly liability. Also, it makes sense, right? Because you have tax advantages, possibly with a mortgage that you wouldn't have on consumer debt, but obviously check with your CPA, okay? So step number 2 would actually just be avoid some of this debt to begin with. So in the months leading up to it, or year really, if you charge less to your credit card, or hopefully not charge nothing at all and just use cash, your minimum payment on your cards is gonna be lower. And then you're already going into the application with less debt and a better debt to income ratio. Just for round numbers sake, you really want it to be no more than 40%. There are times you can qualify above, but let's just say you really ideally want it to be below 40%. Tip number 3 could help a lot of people, and it's not spoken about much. I've seen very little information on it. And that's actually asking your loan officer to gross up your income, which is really just giving you extra credit for your income, so long as it's not taxable. So let's say you're a senior and all you get is Social Security checks for your income, or that and like a limited pension. You're probably not paying federal income tax on your income, or at least part of it. Any part that you're not paying, the loan officer should be able to gross up for particular forms of income. I'll leave a more detailed list below. So by product type, FHA loans, your income can be grossed up 15%, VA and conventional 25%. So there are loan officers that aren't aware of this, or it might not occur to them. So you want to be aware of your tax situation going in, because that can make a large impact on your application being approved or not, grossing up your income. So again, I'll leave some helpful links. I'll leave my newsletter on LinkedIn that gives insider information on personal finance, real estate, mortgages, and it's quite detailed. It has a lot of really good links. To get the same information elsewhere online, you'd have to go through a lot of different sources. So I'll leave that below, and feel free to comment and like.